Shares of Lyft are up an incredible 28% late in the day on Friday after announcing first quarter 2025 earnings that beat estimates. But I think really what's going on here is that investors are realizing this isn't just a company that's doing well. It's a company that's extremely cheap. Even after the bump in the stock today, shares are trading for just about 6 times free cash flow. So that's why the company's increased their buyback program. There's a lot of growth opportunities internationally. Autonomous driving is coming. If you have been watching asymmetric investing, you know that this is one of the stocks that I'm the most bullish on. Today shows why. But let's dig into the results. My name is Travis Hoium. Thanks for watching asymmetric investing. Please subscribe here on YouTube for all my content. And thanks to this video sponsor, The Motley Fool. If you go to fool.com/ASYM, they'll give you their top 10 stocks to buy right now. Let's start with the slideshow that Lyft puts out each quarter. Just some high level numbers. Gross bookings was up 13% year over year to 4.2 billion. That's a record for the company. Rides were up 16%. So there was a little bit of pressure on pricing. That was one of the things that coming out of the fourth quarter 2024 results. Investors were a little bit worried that pricing and margins were going to be under pressure. So saw a little bit of that, but margins actually held up well. 2.6% was the adjusted EBITDA margin. That's pretty good. I'll get to some of the comparables on that, but they also announced the acquisition of Free Now. This is actually a service that interacts with taxi services in Europe. But this could potentially, and this is the way that they're kind of framing it, double the company's total addressable market. This is a cash acquisition. They're able to just put on with the cash that's on the balance sheet. I'll get to some of those details in the free cash flow, but I think really increases the addressable opportunity, and this leans into fleet operators in autonomous vehicles. This continues to be what I'm ultimately the most bullish on. I think that, look, Lyft stock is a great value. There's relatively little downside from a valuation perspective, and all the upside is in the growth of the business, the growth in autonomy, the potential market share gains that they could have if they increase supply with autonomous vehicles, and then, of course, margin and multiple expansion. When you have a cheap stock like this, if it goes from a cheap stock to a more fairly priced or more expensive stock, that's where you get really, really phenomenal returns. So I think those still could be ahead with us with Lyft shares. I do want to go through kind of the high level numbers because these kind of ebb and flow quarter over quarter, but you can see that their bookings are just consistently getting stronger quarter after quarter after quarter. There's a little bit of seasonality, but the number of rides continues to increase. And then here's that margin profile. You can see that Lyft has now proven that it is consistently profitable, consistently producing those margins in that 2 to 3% range. But here's the big story, free cash flow. $920 million in free cash flow for a company that, as I'm recording, has a market cap of $5.5 billion. Now I'll get to the buyback program that they announced, but that is a really cheap stock for that kind of free cash flow, especially when you consider Lyft is not a company that has a lot of capital expenditures. This is a pretty capital light business. They also said for the next quarter, this is just Q2 2025 guidance, expecting bookings to increase another 10 to 14%, adjusted EBITDA to be $115 to $130 million. So you're going to continue on that run rate of about $500 million per year. And then those margins are going to increase just a little bit. This was the big news. I think this is one of the reasons that shares are up as much as they are today. Increased their authorization to repurchase shares to $750 million and accelerating that with $500 million in the next 12 months and $200 million in just the next 3 months. So Lyft thinks its stock is extremely cheap, and they're saying, hey, we got cash on the balance sheet. Here's a look at that cash position. You can see that in total, cash is nearly $1 billion, short-term investments, another $1.2 billion. So why not put some of that money to work? They're buying Free Now. They're also buying back a whole bunch of stock. And even after you make those kinds of investments, they're still going to have a pretty solid balance sheet. This is probably going to be the limit until they start generating a little bit more cash because you do have a little bit of debt on the balance sheet. The convertible notes that are current, those are going to be due in the next year, $390 million. You do have some long-term debt of about $550 million. And then there are insurance reserves as well. So that's something that these ride-sharing companies are going to have to keep on their balance sheet. Thanks to our friends at The Motley Fool for sponsoring this video. Visit fool.com/ASYM for the top 10 stocks to buy right now. But look, I think it's steady as it goes. And the interesting thing with this move is I wasn't all that surprised with the results. This is basically what we've been seeing from Lyft for the last few quarters. They're getting to the point where they're consistently profitable. They're generating free cash flow. David Risher has really turned around the business's operations. Not a super high growth company, but growing in double digits is going to be pretty good given the current valuation. And ultimately, I think the upside continues to be in autonomous vehicles. This is a look at the image that they put this out a couple of months ago, and I've highlighted it here on asymmetric investing, but this just shows how they look at the supply chain. So you have autonomous vehicle technology, the vehicle manufacturing, and then who's going to own and finance those vehicles and who's going to manage the fleet. Those may be completely different things. Maybe have somebody who owns a vehicle or does financing. So that would be the Marubeni in Lyft's ecosystem, but who does the fleet management? Lyft maybe is doing the fleet management in that case. And then you have the platform that's in the rider experience. That's going to be more what Lyft is doing. So what they're saying is, hey, we're going to play in all four of these areas. We're not necessarily going to be a financing company or an ownership company, but we are going to partner with companies that are going to enable us to scale the business without us using a whole bunch of our own capital. Then when you get to fleet management, we will do some of those things. We'll take maybe tens of thousands of vehicles, of autonomous vehicles, especially if they're electric vehicles, and say, who's going to charge those? Who's going to maintain them? Who's going to clean them out on a regular basis? Well, we've got some of the infrastructure to do that with FlexDrive. So that's the way that they are thinking about leveraging that business and that subsidiary, at least in the cities that they're operating. This is not something that's going to happen overnight. It's not going to be tens of thousands of vehicles in, let's say, New York City in the next year, but they are starting to launch small kind of pilot programs. So they're going to be in Atlanta. That's with May Mobility, their partner there. They're also working with Mobileye. That's another stock that I own. I think is in a really good position in the technology piece here, but they're already operating in Austin. Mobileye is also looking at moving to Los Angeles, but that could be operating almost anywhere. The real charge that we need to see is these autonomous vehicles start to get licensed and start to actually get on the roads, because that's when you're going to be able to increase supply if you're Lyft of autonomous vehicles. And the 10x or 100x opportunity for them, it's not just expanding the market because autonomous vehicles answer sort of the supply problem in this supply demand dynamic in ride sharing. It also could potentially help your costs and actually reduce some of the friction that you have in the business. Not everybody necessarily wants to get in a car with another driver, but if it's not only lower cost, higher availability, and it's kind of perceived to be safer for an individual to get into a vehicle, an autonomous vehicle, that is a really compelling option. And really where Lyft has potentially more upsides than some of its competitors is that it has this low valuation. Uber, for example, is about 4 times as expensive on a price to sales multiple. So just that multiple expansion could be like rocket fuel for Lyft stock. That's one of the reasons that I own this stock, and I own both Uber and I own Lyft. I also own Mobileye. So I have like an autonomous vehicle basket there. But Lyft is one of my favorites. It's one of the companies I've actually invested the most in this space. And that's because I see optionality and value. And if you look at, there's really only 4 reasons that stocks go up. They go up because revenue increases, because margin increase, because multiples increase, so price to sales or price to earnings multiples, and then because companies are buying back stock, reducing the denominator when you look at earnings per share. Lyft really has all 4 of those things as tailwinds. So I love the position that Lyft is in. I love the way that they're operating. The market seems to be appreciating at least this quarter. We'll see what the stock does over the next few quarters, because like I said, I don't think these results were all that surprising, but obviously the market did given the pop in shares today. But let me know what you think of Lyft. Leave your comments in the comment section below. Don't forget to subscribe to Asymmetric Investing. Thanks for watching, everybody. See you here next time.